take your hand off the mouse. Stop scrolling through that brokerage app. Before you even think about clicking buy on another tech stock or some viral AI company you saw on a TikTok ad, you need to listen to me very carefully. The rules of the market didn't just change in 2026. They were incinerated. If you're still using the 2021 playbook, you aren't investing. You're gambling with a house that has already been foreclosed on. We've all heard the stories of the everything bubble. We've seen the 401k wipeouts, the collapse of the tech giants, and the death of the easy money era. But while 99% of people are panicking and pulling their money into cash that is losing value to inflation every single hour, the smartest players in the room are doing the exact opposite. They aren't looking at the flashy screens. They're looking at the plumbing. They're buying the companies that own the world's actual physical reality. In this video, I'm going to show you why your current portfolio is likely a ticking time bomb. And I'm going to reveal the 3 sectors that are effectively the new goal of the 2026 landscape. These are the stocks that don't care about a stock market crash because they provide the things humanity literally cannot survive without. But before we get to the tickers, we have to look at the math of why the old world died and why growth is now a dirty word. Let's start with the growth trap. For 15 years, we lived in a world of 0% interest rates. This created a generation of zombie companies. These were businesses that didn't actually make a profit. They just grew their user base and burned through venture capital, hoping that one day they'd figure out how to make money. Imagine you're a CEO of a grocery delivery app in 2021. Hey, we lost $1 billion this year. You tell your investors, they smile and give you another $2 billion. It's fine, old sport. Just keep growing. But in 2026, the free money disappeared. When interest rates hit 7%, those billion-dollar losses became a death sentence. The 2026 crash was effectively an asset-backing audit. The market finally stood up and said, I don't care how many followers you have or how advanced your AI chatbot is. What do you actually own? Do you own a factory? Do you own a pipeline? Do you own the minerals in the ground? If the answer was no, the stock price went to 0. This is the first rule of 2026 investing. If you can't touch it, you don't own it. This leads us to our first plumbing sector, the logistics lords. In a global war scenario or a trade blockade, which we've seen dominate the 2026 headlines, the most valuable thing on Earth isn't information. It's the ability to move things. We spent decades building a world where we thought shipping was free and unlimited. We were wrong. Imagine the ocean in 2026. It's a series of locked gates. The companies that own the massive port terminals, the deep water tankers, and the rail networks are the ones who decide who gets to eat and who stays in the dark. These aren't tech companies. They are old, boring, and highly profitable. While the S&P 500 was dropping 30%, the companies controlling the Strait of Malacca and the Suez Canal shadow fleet logistics were seeing record-breaking cash flows. They have what economists call infinite pricing power. If they raise their shipping rates by 500%, you still have to pay it because the alternative is having no food on the shelves. That is the math of a must-have asset. But wait, don't just run out and buy any shipping company. You need to look at the energy density of their operations. This brings us to the second sector, the resource fortress.
We've already talked about the 2026 oil crisis and how Russia and the Middle East used energy as a tool of blackmail. But while everyone is staring at the oil price, the real wealth is being built in the battery metal and fertilizer mines.
I want to build a green future, a politician says in 2025. But to build that future, you need copper, lithium, cobalt, and nickel. And here is the problem. The world hasn't built a new major copper mine in years. We are facing a physical deficit that no amount of money printing can fix. In 2026, the companies that own the rights to the high-grade copper in South America and the lithium in Australia became more powerful than central banks.
They don't have to find customers. The entire world is banging on their door, begging to pay whatever price they ask. And then there's fertilizer. As the 2026 global war impacted the price of natural gas, the cost of nitrogen-based fertilizer skyrocketed. Suddenly, a company that owns a potash mine or a phosphate deposit isn't just a chemical company. They are the gatekeepers of the global food supply. When you invest in these companies, you aren't betting on a stock price. You're betting on the fundamental calories required for human life. In a recession, people cancel their streaming services, but they never cancel their need for bread. The math of the 2026 resource fortress is simple. Scarcity equals sovereignty. Finally, we have to look at the most controversial sector of 2026, the defense tech autocracy. In 1929, the crash led to a decade of stagnation. In 2026, the crash led to a surge in government spending on hardware security. We are seeing a military renaissance. But forget the old-school tank manufacturers. The real money is in the autonomous infrastructure companies. These are the businesses building the drone swarms, the satellite defense networks, and the AI-driven border security. Hey, we don't have money for schools or roads, a government official says in 2026.
But we have unlimited money for the defense budget. This is the inelastic demand of the state.
Governments will let their currency devalue to zero before they let their defense systems fail. Investing in the companies that provide the plumbing of national security is effectively a hedge against the very collapse of the system itself. They are the only companies with a guaranteed inflation-adjusted paycheck from the most powerful organizations on Earth. But Hudson, you might say, aren't these stocks already expensive?
This is where the retail mirage comes in. Most people are still looking at price to earnings or PE ratios.
But in 2026, PE ratios are useless because earnings can be manipulated by accounting tricks. Instead, the smart money is looking at replacement cost. Imagine you wanted to build a new deep-water port from scratch today. Between the environmental regulations, the labor shortages, and the cost of raw materials in 2026, it would cost you 10 times more than the current market value of the company that already owns one. These companies are trading at a physical discount. They own assets that literally cannot be replaced. While the digital assets can be duplicated or replaced by a new AI overnight, a rail network or a copper mine is a geographic monopoly. The math of 2026 investing is about resilience, not growth. We spent 20 years chasing 10% annual returns in the stock market, while our basic cost of living was rising by 15%. We were actually getting poorer while the numbers on our screen went up. To survive the post-2026 world, you have to invert your thinking. You don't want the company that might change the world. You want the company that owns the world. So what is the strategy? First, you have to audit your current portfolio. If you're holding companies that rely on consumer discretionary spending, things people buy when they feel rich, you are in the blast zone of the 2026 recession. If you're holding tech companies with no physical products, you are holding digital air. Second, you need to look for vertical integration. In a world where the supply chain has snapped, the company that owns the mine, the refinery, and the shipping fleet is the only one that will survive. They don't have to worry about a global war impacting their prices because they are the price. Finally, you need to stop thinking about the market as a single entity.
The S&P 500 is a graveyard of the old world. In 2026, there is no market. There are only islands of productivity in a sea of debt.
Your job is to find those islands, Buy the plumbing that runs them and ignore the noise of the ticker tape. The 2026 stock market crash was a tragedy for those who believed in the illusion of paper wealth. But for those who understand the math of physical resources, it was the greatest opportunity in a century. We are moving from a financial economy to a physical economy.
The crown has passed from the Silicon Valley coder to the resource geologist and the logistics engineer. Don't invest another dollar until you can look at a company and see the pipes.
Don't buy a stock because it's going up. Buy it because if it stopped working, the world would stop turning. That is the only safety left in 2026. Everything else is just waiting for the next margin call. We spent 40 years building a world that was efficient but fragile. Now we are entering an era that will be expensive but resilient. The transition is painful and the math is unforgiving. But for those who can see the plumbing behind the narrative, the future isn't a crisis, it's a roadmap. Mainstream media sells stories. Hudson Invests reveals the math. If you want to see the plumbing behind the narrative before the system breaks, hit subscribe and turn on notifications. Like this video to stay ahead of the crowd and leave your take in the comments below. Stay sharp.
I'll see you in the next one.